In this video, traders, we're going to answer a question from a subscriber, thank you very much, asking about stop hunting institutions, stop hunting retail traders. Stick around. Hey guys, warm welcome to you. Thank you very much for joining me. All right, so ES Anoop, appreciate you putting in this question, ES, whatever your first name happens to be. Hi Mark, how is it that institutional traders do stop hunting of retailers? Are they looking to order flow and things like that? Can you please, and he also says, can you please urgently do an interview of an institutional trader and ask them about how exactly do they trade for their firm or clients? What tools or software do they use to target the retailers? You can do this by not revealing their true identity, blurring, hiding their face, etc. Let's address this stop hunting thing first. I don't think Goldman would want to come on here and do an interview, if I'm honest, but hey, I don't think, this is my opinion on it, I don't know for sure. Institutions aren't necessarily specifically trying to stop hunt retail. Why do I think this? Well, let me just measure this for once in kind of two different categories. So you've got stop hunting in things like Forex and the indices and futures. I just don't think that exists because we don't have enough contracts for them to be that interested in. Now, if you're talking about a stock potentially that's run on by retails, the massive amount of people in it, let's say GME, AMC, one of those things as meme stocks, that's slightly different. I think that there may be institutions that will probe and push and move markets or help to move the market because they know the participants have weaker hands, etc., etc. But let's look at kind of the broader picture for now. So, my opinion is they don't really care what retail traders are doing. They don't really care. Now, there are predatory algos out there who are sniffing around for institutions. So these are other institutions looking for other institutions, and that's slightly different. So then you could hypothesize and say, well, if they're doing that, are they not looking around to see what retail traders are doing? There's an argument to say maybe, but I think it's more like this, okay? And I'm gonna try and draw it on here to what I believe about goes on with stop hunting. So imagine you've got a level here. Everyone's trading off this level. It's a daily low, for example, and your average retail trader has a stop below the daily low. Fine. Now, often we get a market that pings out through here and pushes back up. Now, some people, again, are in the camp of, well, it's stop hunting. Now, yes, that's a good way of framing it, but I don't believe that there's institutions out there. Because think about what has to happen. They have to sell at lows, sell at lows, sell at lows through any layer that might be there. And don't forget, if it's an index that's affecting all the stocks in that basket, they've got to sell. They're now net short. They've got to assume there's going to be a lot of sellers under here, sell stops, and then buy those. There's got to be enough to cover that short position. Otherwise, they ain't going to make any money. Because if they do that and there's no buys there, or there's not enough contracts there, they're not going to make any money. They're going to cost them money. Now, in the pit days, I'm going to digress and hopefully remember where I am when I come back to this. In the pit days, you'd have a number one local. A number one local would push the market. He would be aggressive, knowing that the other locals had to come out of the position, and that would cause a cascade of stops. So that was definite manipulation. He was pushing. He knew those other guys were stuck, but he was trading, looking at them. He was seeing some guys were stuck in big positions, and he had a big enough bankroll and was aggressive enough in the pit to force the market through the lows. He'd cover and get out. Now we're in different times now. So for them to do that, it's going to cost them money. And I just don't know whether they know for sure there's enough money in it to do that. Now, we're going on different parallel tracks here, so hopefully you stay with me. The reason I think that we get this is that if you can imagine, right, as we get to a key level, the buyers and buyers become less and less and less and less, because if everyone's got their stop underneath that level, they're all selling there. Now, once they've bought, then you've run out of buyers. You've had a 1 touch, 2 touches, 3 touches. There's no more buyers there. And so what happens is it naturally trades through the level because it's tested so many times. Then we get the cascade and we get the ping lower. That's the stops getting pinged because stops are market orders getting fired into the market, you know, and they're hitting all those bids and it's just cascading down and then popping back up. It looks like it's kind of purposeful, but the reality is just the liquidity vacuum that forms on the ask as we go through that bid and it rips back up, and that's why we get those kind of wicks and little V-shaped things. So the question is, are institutions doing this? Again, I don't know for certain, of course I don't, but is there a time when there may be one or two smaller firms forcing it through lows to see what happens? I know for myself as a trader, when I've been trading very aggressively on DAX or Dow futures, I mean not so much Dow futures, DAX more so, if it was the lows I was short, I would hit the bid, purposely hit the bid aggressively to try and be an extra person who adds the weight and just causes the cascade of stops like a cover into. So, you know, you thinking, well, if I hit that bid, or the bid just drops and there's another level and I hit that, it's going to, you don't know, even someone trading a small, relatively small amount in the scheme of things, that all adds fuel to the fire. So, you know, are there institutions out there who recognize maybe there's a little bit of illiquidity, maybe they could just get a print on the low and that print on the low would cause it to cascade lower? Because don't forget, they don't know, they could just get a couple of ticks lower. It cost them, let's say 400 or 500 grand to get it there, and then it pops back up. They're going to lose a couple of million. It's not worth it for them. They want to do it to make some money. And I think they don't think they do it on purpose. I think it's purely the situation where there happens to be a lack of liquidity there. You know, most of the time there's a lack of liquidity, and then that's causing the cascade through because there's a sudden burst of a lot of sellers in a very short period of time. It wicks through, it pops back up. You know, that's just a liquidity vacuum. So with the question going, what tools and software do they use to target the retailers? Again, I don't think we're a target for them. In this specific environment, are we a target if you're trading as a heavily retail involved stock, that everyone's trading like on Wall Street bets and all that kind of stuff? Potentially, yes, absolutely. I think that the institutions know where the retailers are, and they may well move that stock, or they may well pressure on that stock. And say move, you've got to be careful when you say things like they'll move the stock. It's not free. It costs you money. If you want to move, if you go in with the objective of moving a market, depending on what market that is, it is going to cost you a significant amount of money. Now, of course, institutions do have a lot of money, but it's not a risk-free trade. You know, if they're going to say, right, I want to shutter this price, let's imagine it's ripped up here and they know there's a lot of people piled in here and they want to drag it down here. I'm not saying this doesn't happen, because I think maybe more likely in some of these meme type stocks or retail involved stocks, that costs you money. But you still need, after you've triggered that momentum, you still need at that point when you've backed off the throttle and you've got all that short, or whatever your reasons you're doing, you need that to continue and you need people to sell. So you've got to be pretty accurate with this. You've got to be pretty good. Now let's be honest, they don't have an insight into where they don't have a feed for all the brokers, and the brokers are revealing where the stops are. They just know, like we know as traders, right? We know that it stops under lows. We know that when there's a stock has ripped very, very heavily at the early hours, that a hefty pullback is going to cause a lot of the late buyers who are sitting in their boxer shorts rolling up too late buying it to come out. We know this because we know the other side of the trade. So institutions obviously do know this, but are they pressing around all the instruments? No, I don't think they are. And obviously they're not with some of the bigger currency pairs. Absolutely not. Guys, are pathetic size compared to the huge amount that's going through the currency pairs. There is no way they are purposely pushing it through a level to try and ping out a couple of retail traders. They're just not doing it. The reason it's happening is because the level is a significant level and there's just a lack of buyers on that level because they're all buying before the level. Then when it goes through the level, naturally, think about this. And again, I don't know if I'm right on this, but bear with me. So imagine you have, where can I draw this and you can still see it? Here, we can go just about here. Right, imagine you have, this is a key level, right? Your job as a buyer, institutional buyer, you've been mandated to buy, not using the word mandate at the moment, but you've been chosen or given instruction, should I say, to buy a specific asset. Your job is to buy it at the cheapest possible price, right? that's what we're doing as buyers, the cheapest possible price. And so if it's kind of holding at this level, you're going to be buying. You're going to be buying, buying. Now all of a sudden, if it goes through that level, you're like, oh great, I can get it much cheaper. Let's see what happens to it. And so there's a little lull where there's a lot of buyers. Now some people are stepping in, but don't forget there's a massive amount of potential selling hitting that through that level. And buyers are like, well, let's just see if it goes lower, I'm going to buy it lower because that's my job as a buyer. If I can, it was at 50 and now it's at 40, it's at 30. Great. Go back to my client, say, hey, I bought it for you. I got filled at 30 and the client's like, well done. Here's a Porsche 911 GT3 RS. I'm joking. So the point is, and then when it doesn't, it bounces straight back up. They go, okay, I'm gonna have to buy a step back up again and start paying $50 again. And because it's a quick bounce back up. But you can see that it's more the psychology and the position of people, I think, why we get these kind of wicks through level and breaks through levels, as opposed to some secret software these institutions have that see the order flow and get feeds from brokers where stops are and push it through. I just don't think, but collectively we're big enough. Okay, in some of the stocks, I'd say that's a slight exception to the rule, but collectively, it's not worth it for them. There's no advantage. It's costing them money to do that, and they're assuming they're going to make more from it from doing that, push it through a level, and then we're all going to go, we get stopped out, and they're going to be able to cover the position and make money on it bouncing. I just don't think that. I could be wrong. I don't know for sure any of this stuff, but that's just my opinion on it. I think it's almost a self-fulfilling prophecy that there happens to be low liquidity in that area, causes that to vacuum through, causes a little bit of a flurry on the sell side, pops back up, that type of thing. I hope that's kind of answered the question in a little bit of way. That's getting my opinion on it. That's the way I feel about things. And at the end of the day, guys, from an operational perspective, how can you leverage this to your advantage? If you see a market that's constantly, you say, getting stop hunted, whether that is intentionally or that's just purely by the supply demand nature of the market, how can you take advantage of it? I know from my perspective, I'm always looking, where would it test and come back that would give me a good buy signal? And so I'm on the other side of everyone who's getting stopped out. Stop putting your stops in places where you get stop hunted and start putting your limits in places where the majority of people are getting stop hunted, and see what kind of results you get. Take care. See you next one. Bye bye.